Welcome back. I had to cut out the video from last time because something came up. I had to go do something, but we were talking about the cash flow statement, and then we talked about your operating activity section of stuff, right? And then from your operating activities, we know that our second thing that we have to account for is your investing activities, right? Your investing activities. Your investing activities. This is basically stuff like cash spent on um, for example, building, cash spent on building stuff, or collected by selling. Right? That's your investing activities. We start off here by subtracting our capex. You're going to subtract out your capex. What is capex, you may ask? This is something known as your capital expenditure, right? Your capital expenditures. What your capital expenditures is basically cash we spend on long-term kit like machines or buildings, anything that's working, anything that's capital for the business and that costs something. For most companies, this is the big one, which is like just PP&E stuff, machines and buildings and that kind of stuff. So that's going to be, for example, let's just say you're subtracting 50 out, right? You can also, what you add back are proceeds from sale of PP&E. And if you want to learn more about PP&E, what it is, and all that stuff, we talked about it in a balance sheet video. But PP&E is basically your plant, your equipment, and property. That's your stuff. And we add back, let's just say $8, because this is stuff like we let's just say we sell off some equipment that we no longer need. This turns into cash coming back into the business. So you're adding back that 8. And then next, you subtract out your acquisitions of businesses. And why do we do this, you may ask? Because say you buy another company, obviously a big lump of cash is just going straight out the door. And if that's a cash outflow, so we're gonna have to subtract out, say, $40. It's obviously not realistic numbers. We're just using these as examples. So here we would come back here, we would add something known as proceeds from divestitures. Divestitures. This is basically the opposite. So say we sold a business unit that we sold a business unit that we own, right? We owned previously. This means that cash comes in. That's basically what divestitures mean. So say we have a subsidiary company and we sell it for, I don't know, $5, right? You're basically adding that 5 because it's a cash inflow to the business. So you add back that 5. And next you subtract out something known as your purchases of investments, right? Your purchase of investments. Let's just say this is $15. Say this is pretty much in the name itself. Say, for example, we parked spare cash in stocks or bonds. You invest in these stocks and bonds. It obviously left the account for now, and it can still be an asset, right? It's still an asset to you, but it's not in cash form. So it counts as a cash outflow. So you're subtracting out, for example, 15. And then here we would also add back stuff like sales or maturities of securities or investments, right? Your investments. So, for example, say you want to cash in those investments. Say you want to sell some of your stock options, or you want to sell some of your investments specifically. You would get a cash inflow to the business. So that would mean, for example, let's just say we add back $10, right? Because the money returns to the accounts. Next, we subtract out something known as purchases of, I guess, intangibles. Intangibles is stuff like software and that type of stuff. Stuff that helps the business, but at the same time, there is a cash outflow because cash we spent on building long-lived things like our own software, we treat it like equipment. So equipment, at the end of the day, you're putting that money into an investing activity. You're going to say, let's just subtract out $6. And then at the end of the day, we're going to come back and get our cash from investing activities, right? Your cash from investing activities. And this is going to end up as negative $88. And this is usually negative for a healthy company. Usually a healthy company has a negative investing activity section because it is putting cash into its own future. That's the main thing you got to know. So it's going to be negative $88. In the next video, I'm going to be going through the last section, which is your financing activities, and kind of tying it all up together for your cash flow statement. And then after that, we'll make a video on connecting all three statements together. Thank you.